Welcome, everyone, to Diversified, where our mission is to have you living a life filled with wealth, health, and happiness. Today, we have a very special guest, one Ed Lynch, who many of you know. He is a CPA to the stars. He also runs and is our head CPA of Diversified Tax as of December last year, and we're excited to have him on board. So how you doing, Ed?
Good, thank you. How about you?
I am doing great. I'm doing great. So as you know, we like to interview people that fall in one of sort of three criteria: wealth, health, or happiness. Really, as a CPA for dozens of years here at this point, I won't date you too much. You've seen thousands of returns and thousands of taxes. So help me understand. Let's get some tips here for some people. What would you say are some of the most common ways that someone can reduce their tax bill?
Sure. So one of the most common items that we see is for people who are participants in a health savings account. A lot of times they'll withhold some amounts through their payroll, and sometimes their employers will also withhold or put into the account a set sum of money each year. But the IRS allows taxpayers up until the tax filing deadline of April 15th to put more money into their HSA to bring it up to potentially the max amount for the tax year.
It's a great tip. And for those that aren't familiar, HSAs or health savings account, one, you don't have to use them each year. You can let it accrue. And two, money goes in pre-tax and comes out tax-free. So it kind of works as a Roth and a IRA sort of at the same time, which is nice. Okay. Good. So HSAs, great vehicles. And if you're 55 or older, there's even a catch up you can do, correct?
Correct. Of extra $1,000.
Right, which is real.
Yeah, and it as long as it's used for a qualified health costs, which can be when somebody retires, it can be their supplemental health insurance. They may have to get over and above Medicare. We have many clients whose HSA accounts are in the $50,000 to $60,000 to $70,000 range of what's in them now.
Right, and you can use them to pay for Medicare costs, can't you?
Correct.
Which is great. So deductions is like this abyss of unknown, if you will. What are the different types of deductions, or most common types, and maybe errors people make with them?
So the most common tax deductions are if you do itemize, which in the last couple of years since the Tax Act of 2018, many people have now taken the standard deduction. But the most common itemized deductions are state and local taxes withheld from people's paychecks, real estate taxes on primary home, secondary homes, and also mortgage interest on your primary residence and on a second residence. And the big one, which helps you if you don't itemize, is the charitable contributions.
Right.
And what I mean by that is, if you don't itemize for 2021, you can still deduct, if you're married, up to $600 of charitable contributions on the front page of your Form 1040.
Okay, a nice little tip. And I know if you are going to have maybe you're into your work career, or in the future you're going to be in position to just standard deduct, you can always do like a donor advised fund and lump a bunch of years of deductions up front, so you can itemize year one and not lose that in the future years.
And really the only thing to make sure that you're comfortable with is that when you put investments into a donor advised fund, or if you directly donate securities to a 501c3 charity, there's a 30% limitation on how much you can deduct, and that's based off of your adjusted gross income. So that's where tax planning comes into play in terms of if it's a sizable donation into either directly or to a donor advised fund, you want to make sure that you get the full benefit in the year that you're doing it. If for some reason your income isn't enough, whatever amount that you can't use gets carried forward to the next year, and then it's lumped in with everything else, and that's a 5-year carryover.
So you don't lose it. Okay, you said something interesting there, Ed, and maybe the first time ever potentially. You you mentioned tax planning, and I know as part of the diversified tax entity we started and you're running, essentially tax planning is a big part of it, and this time of year is not necessarily the time where you can tax plan for 2021 and in the thick of getting your taxes done. But when you sit down with people in the next quarter or two and sort of the year is on its way, what are you really looking at when you tax plan?
So the primary people that we do tax planning for, or our clients, are people who either own their own businesses and or they work for companies that are paying out bonuses, incentive options, different types of deferred comp that businesses in the last couple of years have been paying out in huge sums. Also, if you've changed employers and they pay for your moving costs, a lot of time, most of those costs get added to your income. So what we do is we basically to take a look at your current year income that's already happened or what you think is going to happen, and then we build the projection for that particular current year to see are you withholding enough, are on those one-time events like moving costs or option exercises or bonuses. Your employer is required to withhold 22% IRS tax. You can't get any more. You can't get any more, can't get any less unless you're over $1 million of compensation. A lot of times that 22% is great for that particular income event, but what happens is it drives up your average tax rate. So your regular weekly, monthly, biweekly paychecks, you're most likely not withholding enough. And that's where we see people who have sizable tax bills.
Right, and can get penalties too.
Exactly.
Okay, so really, you tax planning works best, and for people who have a lot going on, whether that's business owners or people or executives who are getting a bunch of different income streams, and it's really a way for you to get it centered to say, how's this going to project out? One, is there strategies to lower tax things? And two, are we trending in the right direction from withholding so that you don't get a big surprise come April 15th?
Exactly. And on some of the tax plans, it's more of just alerting our client that here's what's coming down the pike so they can prepare for it. Either start paying quarterly estimates or adjust their withholdings if you have enough time during the in the tax year to be able to do that, or just know that come April 15th you're going to have a tax bill. What we try to avoid is that underpayment penalty or reducing it as much as we can.
Right, and I can speak to the validity of this stuff because you do it for not only lots of our clients and on the planning side, but me personally with our business. And it's been extremely helpful to be informed and educated on this stuff. So speaking of sort of the tax services, you've been at this for quite a while, and you've seen people who do taxes themselves say, hey, I'll just throw it in one of these online softwares, and that's fine for some people. But where do you see the value in a lot of cases? Where do you see people get it wrong? Where do you see that, hey, this is really, for not a ton of cost, it's worth utilizing a CPA and a tax professional versus spending the nuisance of doing it yourself?
Well, there's a couple of values there. One is the tax plan that we just talked about. But the other value is having trained professionals prepare your taxes, and get the worry, get you to not worry about gathering up all the information you think you might need, then preparing it, making sure it's right, and then 9 months to a year down the line, have to worry about getting a IRS notice.
Right.
And
Not an entity anyone wants to hear from.
And a lot of times it's those IRS notices are what they call matching notices. So basically, you're preparing your own return and you may have missed a form 1099 from your investments. Switching investments around, you might not get one that you may forget that you switch from one to another, and miss that tax form.
Okay.
A lot of times it's just clients or individuals, families just really don't want to do it anymore. They don't want to have to worry about it. Don't want to have to spend the time where they can spend their time, making money at their jobs or with family, instead of having to worry about getting their taxes done.
Right. So really it's tax planning, it's peace of mind, it's getting time back, it's dealing with nuisances, it's with the IRS and making sure it's done right. What would you say the number one mistake you see people that do it themselves come across?
It's basically missing a 1099, missing a 1099 for investments,
Gotcha.
especially when they've had sales of mutual funds or securities. What happens is, depending on when you purchase the investment, the IRS doesn't get the cost basis from the investment company. So if you have held on to an investment probably 10 years or more, what happens is you sell for $100,000. That's all that's reported to the IRS. You actually may have a cost basis of $110,000, but the IRS doesn't know that. So you'll get a nice little letter in the mail saying you owe $25,000.
Got it.
And in reality, you don't, because you had a loss, but the IRS doesn't know that.
Makes sense. Okay, great tip and great plug. So, all right. So two final questions for you. One, since we're all about people living their best lives, what makes Mr. Ed Lynch happy? What brings joy to your life? And I see you're plugging a specific soccer team over there. So you tell us.
Well, in my non-tax season period of the year, I referee a lot of soccer games, girls, boys, amateurs, and in the fall I also coach high school soccer up in Malvern.
Yeah. Go ahead. What's the team? To give us the plug there.
Villa Maria Academy.
They got some all-stars there, and I know I've known Ed for a long time, and I can honestly say, besides his beautiful wife and two girls, it's a big passion of his. And we tease him because he bails out early sometimes for soccer games during that time of year. But the fact he puts in from January to mid-April about 2 years worth of hours, it certainly he needs to vent. All right, Ed, give us your last tax nugget tip that you want people to remember from today.
So 3 things. If you're over 72 and you're taking and you have to take a required minimum distribution from your IRA, something to think about is that you can do under current tax law qualified charitable contributions through your IRA. And that basically reduces your taxable income from the IRA. You can't take the charitable deduction on your Schedule A, but a lot of times with this standard deduction now, you're not using it anyway. So that's one way to reduce your taxable income through your RMD. Also, in terms of preparing your taxes for this year, you want to make sure that for families who have kids and have gotten the child tax credit advance from July through the end of the year, you want to make sure that you summarize that, because that's going to be a reduction of the credit that you get on your 2021 tax return. That's going to most likely surprise a lot of people.
Okay.
And third, if you did receive unemployment benefits in 2021, they're again taxable for IRS and state of Delaware.
Gotcha. And let me ask you one follow-up question before I let you go. So there's a lot of talk in Washington, D.C. with tax laws getting proposed, and then we have holdouts and things may not be as rich and bad as we anticipate. Where do you think this lands? Major sweeping changes, minor, nothing?
I think for the majority of middle class, taxpayers, it's not going to affect your taxes. It's sort of hard to tell because they keep changing it every week.
Right. Okay. So you don't think don't be too scared.
I wouldn't be. You really can't be scared of them because it changes. So it's one of those things that goes back to the tax planning, and we keep up to date on softwares and our information. So when the tax laws change, from our side of things, everything gets updated.
Makes sense, right? And I guess to your point, it just increases the emphasis on working with someone who keeping their pulse to changes, potential changes, and what to do now or later when that happens. So, all right, Ed. So as we know, Diversified LLC Tax.com is their website, and tax services at Diversified LLC Taxes is a great way to shoot any inquiries that you may have, or you can get introduced to our wonderful tax team through your advisor. We'll happily make an introduction and help you out in this year, or answer any questions as being a loyal client. So thank you, Ed, for your time. Go Villa Maria Soccer. And hopefully I know you're busy this time of year, so I don't want to keep you too long, but we appreciate you very much.
You're welcome. Thank you.
You got it. So as always, I'm Andrew Rosen, president of Diversified. Thanks for tuning in, and stay wealthy, stay healthy, and stay happy.